Hi, this is Ben Reppond. Today, March 8, 2022, I'll be giving you primarily the stock market update. I'll cover a couple of things on economics, but we do that the alternating weeks, so we'll get that next week. Obviously, what is on people's mind is the stock market, but also what's driving that is the fear and the issues around the Russia-Ukraine situation. Today, after my comments and my update on the stock market and what's driving the market, I will have a guest speaker, John Kosar. I'll do an interview with him with Asbury Research. I'm delighted to have him with us, and I'll cover that when we get to that point. So thank you for watching. We'll get into this. I thought the first thing I would do is this isn't covered really very much in the Russia-Ukraine situation, so I thought I would cover it. One of the things, and I think this is political, that the U.S. and other countries are doing to kind of punish Russia is to diminish the value of the ruble. The ruble is measured, the U.S. dollar is the reserve currency, and the ruble is measured against the U.S. dollar, as all currencies are, to establish its value. In the last 19 days, the ruble has crashed 60% in value. This chart is the opposite. This chart shows you the value of the dollar relative to the ruble. So in relative terms, the dollar has gone up 60%. But if you invert it from the Russian perspective, their ruble has declined 60% and is collapsing. So that is one way that countries, ours included, is attempting to punish them. I don't know how much this punishes their leader, but it certainly is going to hurt their people. And then there's other methods. We import a lot of vodka in this country, and all countries do around the world. A lot of that is produced in Russia. So restaurants and stores have stopped selling that, and that will have an effect on their economy, and again is in the way of sanctions, is a way of punishing Russia. As we get to the stock market, there is no surprise to you that the market is down substantially. It is in a short-term oversold condition. This doesn't mean it can't go lower. Just like when you flip it around, we get to an overbought condition. Sometimes it can keep on going higher. So here we are. All of the indexes, the Dow, DIA on the left side of the chart, SPY for the S&P 500, QQQ, which is the NASDAQ 100, and IWM, which is the Russell 2000, the 2,000 smallest companies. Those top four are all in negative territory relative to their 20, 50, 100, and 200-day moving averages. All of those indexes are below those averages, which is a very negative and bearish sign. The foreign markets, EEM, which is the emerging markets, and EFA, which is the developed foreign markets, are in the same situation. They're all below their 20, 50, 100, and 200-day moving averages. That can change, but whenever they start breaking below those averages, that shows weakness, and then when they drop below, 1, 2, 3, all four of them, who knows how far that can go. But when here we all are, all of them have fired down. And this is as of Friday. Today we are recording this one day in advance, so we are on the 7th of March. It's going to be released tomorrow on the 8th, Tuesday. But these numbers do not even include the negative condition today, Monday, and it's quite negative today as well. So these are red and getting redder. I talk to people who have had their money invested by conventional financial advisors. I hear their comments about what they say. And one of the questions I ask is, when the market collapses, what do they say to you? And I subscribe. I'm on the mailing list. I won't say I subscribe, but I'm on the mailing list of a financial advisor, and he was basically telling people, sit in your seats, stay still, don't worry, things are going to be okay, things to that effect. And of course, I know he's getting phone calls, and people are saying, "Why don't you do something?" Which is what people say, and so I thought I would bring up the four most common quotes that I hear from people about that their financial advisors say in times like this. They say things like, "We didn't see this coming. You can't sell now. You can't time the market, and you must invest for the long run." Those, in my opinion, are kind of empty words. They're rehearsed sound bites. And I really do believe they rehearse them so that they try to make them sound sincere. It's a horrible antidote to stock market risk. Traditional models for more cautious investors include equities, diversified equities, and government bonds, typically, with some kind of mixture depending on the individual. The problem is that has happened now is not only has the stock market collapsed, but the bond market has collapsed, the government bond market. So and yields have gone up, which means the bond prices go down, or the bond fund prices go down. And so people who thought they had an insurance policy, some kind of protection against equity risk, are finding that the policy they thought they had is not working very well. Inflation and the Fed. We know, I've shown you the charts, that the real rate of inflation, when everything is added back in, including food and energy and the items that they substitute with cheaper items, when those are added back in, the real rate of inflation is higher than 15%. I think it's 15.1, 15.2%. No surprise. I showed you last week that the 9 different food groups in grocery store, I'll say indexes, but food groups, 9 different food groups from grocery stores, have gone up 34% in the last 10 months. You know what has happened to gas prices. I think those have gone up somewhere between 50 and 100%. I mean, I don't know the number, but it's, from getting gas, how much they've gone up. Those are excluded from the consumer price index. So the biggest things that we consume and have gone up the most are excluded. So to bring them back into the index and to show you the real rate of inflation, it's no surprise it's not 7%, it's over 15%. Last week in the Senate Finance Committee, they were questioning Chairman Powell, and Senator Shelby asked this question, making Chairman Powell very nervous, and it was kind of a little bit of a heated exchange. And he said this: Fed Chair Paul Volcker from the 1980s put the economy in a recession to get inflation under control. Are you prepared to do what it takes to get inflation under control? And everyone knew what that meant. What that meant was, if you are engaged in serious rate increases, you will tank the economy. And Fed Chair Powell said, "I hope history will record that the answer to your question is yes." It's a long answer to the alternative of just saying yes. He's trying to get history on his side here. So he's trapped. He is in a box. And if you followed me over the last couple of years, you know that I have been saying this, that when he said on March 23rd of 2020 that I am prepared, we are prepared, the Fed is prepared to print unlimited amounts of money to save the economy. He used the word unlimited, and they printed or released digitally trillions of dollars into the economy and started buying securities in, I think it was about $120 billion of securities every month, and for a long time. So the buying of securities, the dropping of interest rates to near zero, and the printing of money were really the three tools that they used. Of course, the equity market saw that as an insurance policy against equity risk, and the market took off. But we all knew, and Chairman Powell knew, that we will pay a price for that. And here we are 2 years later. But I want to go back to the Wall Street Journal article that appeared right after the March 23rd, 2020 comment. And it said this. The title of the article is How the Fed Averted Economic Disaster. And they did. The subtitle is, As Markets Plunged, Jerome Powell and his colleagues vastly expanded the reach of the central bank. In other words, they did something they hadn't done before, with implications that will be felt for years to come. And here we are, 2 years later, inflation is out of control, and that is exactly the result of printing money. It took a while for it to start to kick up, which it started its surge upward about 6 months ago, and is now continuing to rise. But it was delayed, but we're now paying the price for it. Today, or last week, the J.P. Morgan said this. J.P. Morgan now expects, this is from Barron's, now expects nine straight Fed rate increases until March 23rd. 9 straight increases. So what Senator Shelby was confronting Chairman Powell with was, if this sort of thing that I'm reading is true, you are going to tank the economy, as Paul Volcker did. And Paul Volcker was okay with that. Like, okay, we've got to get in from the late 70s, early 80s, we've got to get inflation under control. If that means the economy takes a hit, it takes a hit. And of course, the economy, the stock market, went down about 50% as a result of all of that. And then, of course, the housing market crashed as well. I don't like to predict the future, but you can connect the dots here. So I'll just connect some dots. Rising interest rates, rising yields on bonds, inflation, all going up, very similar to the late 1980s. High energy prices, oil prices. I've been reading, we may be headed for a $200 a barrel oil situation. We remember, some of us, the long lines at the pump and rationing of fuel, etc. Those are the signs that were present then, and they were trying to deal with how do we avert inflation. And the price was heavy. And I think the price in front of us is not just 2022. I think it's for years to come. I think it's a long period of time where we will be seeing rising interest rates, rising yields on bond prices, stock portfolios and bond portfolios collapsing. I think that kind of a scenario, we're just beginning to see the beginning of that. Okay, we're going to go through some charts. This shows you the S&P 500. This is a one-year weekly chart. So every move in this line, the top line, is equivalent of 1 week in the market, meaning the S&P 500 represented by the exchange traded fund SPY. So I circled on the right side the number of weeks that the S&P 500 has been in decline, and of course there's a 20-period moving average. It broke the trend line. That was an upward trend line, and of course it broke through the moving average and is continuing to go lower. We don't know how far it's going to go, but it is starting to move into bear territory, and it's hard for me to imagine what it's going to take to turn it around. We didn't expect Chairman Powell to say he was going to print unlimited money on March 23rd, 2020. Didn't expect that. So that the market was headed way down, and it dropped 33%. The S&P did. It could have gone down between 40 and 50%. So his goal was to stop that. So is something like that going to come along that is going to stop this? I don't see them shaking hands across the barrel of a tank. I just don't see it. So what's going to happen, we just don't know. But for now, it's headed in a southerly direction. The growth stock index, represented by the ETF VUG, is compared to SPY. So it's a relative chart. And you can see that growth stocks have been out of favor relative to the S&P 500 since December. Small caps, almost an entire year where small caps have been below their 20-period moving average. They're way out of favor. So that's IWM versus SPY. And then this is a 24-month chart, not a 12-month chart, still a weekly chart showing the long-term government bond, TLT. Again, as of today, it's down again today. It's below the 20-period moving average and has had 2 long periods down. No surprise because of rising interest rates. Gold and silver. As of today, March 7, the day before you see this, gold is up to $1,979 an ounce, up 3.8% over the last week. So as stocks have gone down, gold prices and commodity prices, including energy, have gone up. Silver is up slightly to $24.64 compared to a week ago. Now I'm going to introduce John Kosar from Asbury Research, and we'll let him speak about his perspective from his research on the market. So we are delighted to have John Kosar from Asbury Research with us, and he is going to give us some commentary on the market today. He's got a lot to talk about, I'm sure. And John, it's a privilege to have you.
Thank you very much. It's good to be here. And as I am speaking to you, the S&P is down 96. So this is a very good time to look at a couple of our models that answer the question, where should I be invested? When the market is down, most managers need to be invested. They can't go 100% to cash. So these 2 models that we built basically address where's the performance going and where's the money going. So the first one we're going to look at is our CARP model, and that stands for cross-asset relative performance. You can see it on the screen. This is from our research center on the website, asburyresearch.com. And CARP looks at 9 different relative performance comparisons for equities and 3 for fixed income. So I'm going to blow this up a little bit so we can see it better. And so what we do is we look at 9 different relative comparison studies for various parts of the equity market. And then we break them down into 3 different time frames. Trading time frame, which is the yellow heading here, which I am running my mouse across, that's 5 business days. Tactical is monthly or 21 business days here in blue. And in red, strategic is 63 business days or quarterly. And then, so we're looking for outperformance trends that will go ideally across the spectrum of time frames and at least go to the tactical and strategic. So what we see right now in stocks versus bonds, bonds are outperforming stocks in all 3 time frames. And you can see here on a strategic basis, which is quarterly, bonds have been underperforming. Bonds have been outperforming stocks. Stocks have been underperforming bonds since 2017 or Feb 17, and also tactical. So basically for about 3 weeks, bonds have been outperforming stocks. That is typically a defensive move by the market. We have low volatility stocks are outperforming high beta stocks. That's been a little bit newer, just since the beginning of the month, since the beginning of March. Also defensive. You see the S&P 500 is outperforming the NASDAQ 100. So that's typically defensive. People usually go to the NASDAQ if they want to have a little bit more risk appetite, because it's typically typically a little higher beta than the S&P 500. But right now you can see S&P has been outperforming the NASDAQ since DEAS 31 on a strategic basis. And that's our longer, that's the trend we're trying to catch, a strategic, or 3 months. And then we see value is outperforming growth. That trend began right at the end of the year on the tactical and right at the beginning of the year for strategic. And now we see the US is now outperforming both developed and emerging markets. So let's take a broader look at those and look at the best performers. So as we scroll down, you can see all 3 of this week's equities related changes from the previous week could be construed as being defensive, as globally assets are moving back to the US from developed and emerging markets. And in the US, assets are shifting to low volatility from high beta. So I see all of these as the market is kind of going into the turtle a little bit. Prices are getting hit in most of the world. Equity prices, people are moving back to safer places to go. So value stocks have outperformed growth. IWD is the ETF for value. IWF is for growth. Outperformed by 11.7% since 1/4 or January 4th. Large cap has outperformed small cap by 9.6% since November the 17th. And the broad market S&P 500 has outperformed technology, which is the QQQs, which emulate the NASDAQ 100. It's the large cap index, by 7.3% since 12/31. So now let's look at the market globally and see where the money's going globally. So we have our US versus the world model, which measures the S&P 500 SPY versus 24 different global markets that you can see listed here on the left. Everything from Chile all the way down to Russia, China, India. Right now, there are only 7 markets, 1, 2, 3, 4, 5, 6, 7, 8 markets that are outperforming the S&P 500 on a, actually, in this case, across all 3 timeframes. And interestingly enough, the 3 best performers are from South America. We have Chile, Peru, and Brazil. So if we scroll down and look at these individually through 3/4, which was last Friday, this is updated at the end of every week, the 3 best outperformers versus the US are all from South America. EPU, or Peru, has been outperforming SPY, has outperformed SPY by 30.8% since January 4th, since 1/4. Brazil, EWZ, has outperformed SPY, or the S&P 500 ETF, by 25.4% since 1/18, Jan 18th, and Chile, ECH, has outperformed SPY by 15.4% since 1/13. The interesting thing about what's going on right now, 2 weeks ago, 22 of the 24 countries that we track in our US versus the world model were outperforming the S&P on both a tactical, which is monthly, and a strategic, it's quarterly basis. This week, only 7 countries are, actually 8, there are 8 countries are, and 6 of these that were previously outperforming countries from Western Europe are no longer doing so. So all the countries, Italy and Spain and the UK and France, 2 weeks ago, they were all outperforming the US, they're gone now. So I actually, over the weekend, I pulled up a world map to just kind of look to see what was going on. And all the remaining countries that are outperforming are generally geographically those that are the farthest away from what's going on in Eastern Europe. You know, Ukraine and Russia are fighting, and there's dangers that this could escalate into a bigger war. So it's very interesting to me to watch the money move around the board, and then you fit your story to the money. And right now the money is moving, generally it's moving away from all of the European countries. Specifically, it's moving away from the war in Eastern Europe. And the place where you're getting the best bang for your buck right now is in South America, with Peru, Brazil, and Chile very aggressively outperforming the US here so far this year. So I hope that was informative to you, and it gives you a little bit of an idea of where to potentially put some money to work in an atmosphere where the S&P 500 is under pressure and it may continue deeper into the quarter. Thanks for listening.
Good. Thank you very much, John. Appreciate having you.
Very good. Thanks.
It was great to have John Kosar on the show today. John is well respected as a contributor to national media like CNBC and Wall Street Journal. And so as we face this challenging time with the equity markets, I know it is unsettling for some people. Hopefully you have a defensive strategy. You know that I am tactical in the way that I manage money, and John, his research is tactical, meaning that you don't just put your money into one allocation and don't touch it, which is the conventional approach. You make moves in the market to take advantage of market uptrends and get out of the market or minimize risk when risk starts to appear in the market. That's what we've been doing. We've been doing it forever. That's our approach. And this year we went defensive on January 7th. Our models are fairly sensitive. We decreased risk at that point, and then this month we've been completely out of the market. So the risk that's in the market, I don't know where it's going to go in the future, but we will stay defensive until our indicators start to tell us to come back into the market. But hopefully you have a defensive strategy that you really believe in, and that tactical or active management makes sense to you. Thanks for watching.